Hi folks, welcome back to weekly general update for the 26th of June, and markets have been generally a bit on the negative side in the last week. The US market down for the 7th straight week in a row, but a lot of those losses have been pretty marginal. The Australian market has actually been outperforming the US market a little bit in the last couple of weeks, which is interesting. So let's get on to the presentation. So as always, this is general advice only, and you need to weigh up any actions that you take against your own particular financial circumstances and particularly your own trading plan. So the overall action summary for the week: the S&P 500 closed down about 0.4% on the actual week, but started to get pretty volatile, and we saw some significant falls on both Thursday night and Friday night, and the VIX index, which we'll have a look at, is spiking higher. The news looks pretty terrible on the surface. I mean, everyone's wringing their hands about Greece and Spain and Italy, and there's all sorts of doom and gloom, people writing copious amounts of notes on the subject. The US housing market is also obviously in difficulty, so there's lots of really negative things around if you want to go and look for them. But underneath, if you look at some of the economics, it's not all that bad. Some of the manufacturing data that came out of the US on Friday night actually wasn't too bad at all. So we've got to be careful that we don't get overrun by these extreme swings in media sentiment, and it's certainly pretty negative at the moment. And as I indicated last week, the sentiment that I'm seeing at the moment, and has been the case in the US with things like the Investors Sentiment Survey and the Bullish Percent Index chart, which is in the daily alerts, is really at the levels of significant bottoms. We've seen the Investor Sentiment Survey in the US in a 20 to 25% area for a number of weeks now, and that's extremely low levels. So it would be highly unusual for markets to go significantly further down from here when sentiment has been so poor for such an extended period of time. It just doesn't work that way. Significant declines in the market come from points where everybody's bullish. And that's just not the case at the moment, so it is a bit of a strange set of circumstances. Gold was probably the big mover of the last couple of days. It looked like, in fact, it did break out on earlier in the week, and then we had big moves down on Thursday and Friday night. So it ended up losing net $40 on the week, or about 2.4%. It's still easily holding the medium-term uptrend. In fact, it's still well above it. So this correction is a good thing, but given the leverage in gold, you definitely do not want to be long gold at the moment. If you are long gold, then I suggest you get out of it as soon as possible on Monday morning. You just don't want to muck around with this at the moment, because whilst we could see more of a fall, I'll get to that when we actually look at the gold chart. It'll be easy to explain. Silver, still the same as last week, still forming a base. I'm still looking for the $30 to $32 zone for an entry. Copper was encouraging. It firmed on Friday night, very much against the negative trend. So that's a good sign, because copper is such an important indicator of the health of the world economy. And the ASX 200 actually closed 0.3% higher on the week, even though the US market was down. But we will break the 44.80 support on Monday, I'm sure. So that brings into play some lower levels. And as indicated last week, the monthly trend has broken to the downside. So that certainly does open up the way for a little bit lower yet. So overall, we'll just have a look at the strategy, and then I'll get to the charts. So the strategy is pretty much unchanged. The next few weeks are really pretty vital. We've got the end of quantitative easing, and therefore because it's going to make the bond market a lot more nervous, and that will have some impact on stock markets, but I don't have a particularly strong opinion either way about which way things might go. Just playing the ball as they come down the pitch. I think it's still prudent to retain a lower overall exposure and to keep some balance in there between long and short positions is the only way to play that. I would have to say though that in the Australian market, which I obviously know intimately, there is some incredibly compelling value emerging. When you look at BHP and Rio, and stocks like Newcrest and even to a degree, not so much right now, but we're starting to get down into some pretty compelling value area for stocks like Woodside as well. So there certainly is some terrific value emerging. It doesn't mean that markets can't go lower, but it just means that as soon as we see evidence of a bit of reversal in sentiment, that we could see some fairly significant gains pretty quickly. So achieving that balance, it's really buying the dips to support on the majors. I'd be looking to short sell the rallies medium term on selected stocks, the steel stocks, the retailers, the banks, and I'd still pretty much stay away from small caps at the moment. I still see some potential for further downside, and I'm not really seeing the kind of liquidity that's going to give us much of a bounce. So we'll just maintain our low exposure with respect to small caps. So let's have a look at some of the key charts. This is the US dollar index. We've seen this many times before. We're in long-term decline. However, just at the moment, we're getting a bit of a bounce. Certainly, the euro is starting to come under pressure, which is in itself causing the US dollar to go up. So a higher US dollar will tend to be negative for the stock market. So this one is a little bit hard to read at the moment, which is why I'm a little bit unsure on short-term direction. Now this is the volatility index, the VIX index. So we'll just pan back and have a look at what it looks like at the bottom of correction. So this is October 08. October, November 08. So this was right in the middle of the GFC. So we saw an extraordinary spike from the 20 to 25 area in September, and it got up to nearly 100, which I've never seen it that high before. Quickly settled back down and spends most of its time between 10 and 15 typically. We then got another spike in May of last year, which was when we had the May-June correction in 2010. So there was May. This is late May. Here's another spike here in June, a couple of spikes in June. So there's that May-June correction area. So we got up to 35 to 45 area as a spike. Let's zero in a little closer now. So this is more current time. So this is March. You remember we had just a few days of heightened volatility in March, so we spiked up to about 30. Now this time you can see we've started to spike up again. We got up to 20, almost 25, and it started to pick up again on Friday night. So when you get these volatility spikes up above 30, or certainly above 25, it's generally indicative of you're close to the bottom. So you can see we've had a bit of a spike, but we haven't really had that panic washout yet that would signal the bottom. So, you know, I'm really hoping to wake up one morning and see the Dow down 300 points. You know, the S&P maybe down 30 or 40 points, and that coupled with everything else should get us fairly close to the low, particularly if it occurs around about a support level and we see some evidence of a bit of a bounce coming in. So that's what we're looking for. Now let's have a look at this is the S&P on a monthly basis. So this is big picture going back to 1998. So on a monthly basis you can see here was our May and June of last year. You can see what we've gone through. May and June this year is nowhere near as large as May, June last year. So we've got to keep this current decline in perspective. The 10-month and 15-month moving averages are still rising very strongly, and the price is still holding above the 10-month moving average. So there is absolutely nothing there to suggest that we're going into a more significant decline, certainly not at this point in time. And even if we did, we'll get a bounce back up again. Let me just go back and cover that point. You can see here we got an initial decline in 2007. It declined for about 6 or 7 months, and then it bounced for about 3 months and bounced fairly significantly. So you'll always get that sort of bounce. You can see it over here. Back in 99 we got a decline, we got a bounce, we got another decline, another bounce. So even if this is ultimately going to end up in something bigger, there will be an opportunity for us to adjust our positions. Now this is a weekly chart, so you can see the last we've got 1, 2, 3, 4, 5, 6, 7, 8 weeks down in a row now for the S&P, but you can see most of them, particularly the last 2 to 3 weeks, have been pretty mild. So there's nothing really terribly dramatic there. So 1231 is an area that I'm looking at. Let's have a look now at a daily chart. So we've got potential support here at 1248, which is equal to the low here that was formed in March of this year. But then I'm looking at 1233 kind of area. If things got really a bit ugly, we might get down to this 1148 mark, but frankly I don't see it at the moment. It would take certainly some more upset in the bond market for that to happen. So I think we're not that far away from the bottom. Personally, I think this, I'm looking at this area here, this 1230, 1233 type area is where I'd like to toss a coin and hang the hat at the moment. Let's have a look at the gold index. So you can see here, this was the big move on Thursday and Friday nights. Let me just pan back. So here's our bigger picture on gold. You can see we've got a very strong uptrend happening that the price has stayed above. But equally, you can see how far above that trend line that the actual prices have been holding. So if we've got a correction, even all the way back here to 1409, which seems like quite a way down, it's still holding above a very strong medium-term uptrend. So a move back to this 1409 area, I'm not saying it's going to go there, but it's, I think we've got to get through 1471 first. But if that were to occur, we're still in very significant uptrend. So, you know, we've got to keep this in perspective. So definitely do not be long gold at the moment, because I think we will see a little bit lower yet. Now silver, we're looking at, still looking at this 30 to 32 area, kind of a dollar either side of $31 is an important area. So don't really want to do anything on silver just yet. Let's have a look at our market, the ASX 200. This is it on a daily chart. You can see we've got a very strong trending down channel, very clear down channel. We're sitting currently right in the middle of that down channel. It's been holding support. We got a little bit of a false break here a couple of days ago. Went back into the channel, and now we are probably going to trade below this 44.80 level on Monday. So it opens up the possibility for a move down towards this 4200 area. But until we break the top side of this channel, then that's the short-term direction for our market. Let's look at the finance index on the banks. You can see we did get a little bit of a pop up on Friday from the banks, but still haven't really closed convincingly above this downtrending line. So for me, the banks still in downtrend. We'll take a look at the materials index. So we've got a similar downtrending line here, so we're in a clear channel there as well. So we're still below that trending line. And finally, the small ordinaries index. We've broken, well, we haven't quite broken this 2497 area. We got down to a low of 2506, so pretty close to it. You can see also a very strong downtrending channel there, and I still think 2200 is a possibility. So you could see perhaps still another 10% downside in that particular index at this stage. So that's pretty much all I wanted to cover this weekend. It's just a bit more of the same for the next couple of weeks until we get into the first couple of weeks of July, and we can see how the bond markets and the stock markets are going to react to the end of this quantitative easing. So that's it for this week. Talk to you next week. Cheers.